All right, stock market, buying, trading stocks, right? Buying, selling stocks versus futures, buying, selling contracts versus options, right? Buying the right, not the obligation to buy or sell stocks. Okay, so you're brand new, you're trying to figure all this stuff out. What is a way to learn if you want to learn them all? A way, not the way, not the only way, not the best way, but a way. Traditionally, if you're brand new, in my opinion, you try to keep it simple, right? If you learn how to trade futures, you usually use futures for day trading techniques. In today, out today, trying to get paid today. If you win today. If you lose today. Can you position trade in futures? You can, but it can be a little high risk. What comes a high risk comes a high reward too. But usually in futures, there's really only two buttons, right? You can only buy and you can only sell. You have quicker moves, you have leverage, you can make more with less. An example of that, let's say the S&P 500, you trade during the day, E-mini contract, about a $500 investment. That's not your risk, that's just your investment. In the futures, it's kind of like a deposit, and then you have to pick an exit for your loss, and then pick an exit for your gain. So you make ticks and you lose ticks. The great thing about that is it's relatively straightforward. If you think the market's going to go up, you press a buy button, and if it goes up, you make money. If it goes against you, you lose money, you click close, and then it's done. If you think the market's going to go down, you press the sell button, market goes down, you make money. If the market goes up, you lose money, you want to exit, you press close. Very straightforward, okay? So usually if you're brand new, you don't have a whole lot of money, you try to invest very, very small. You don't expect huge home runs, but you have an opportunity. Day trade futures, right? You don't need $25,000 to day trade futures. Some brokers let you start out with like 400 bucks. Okay, stocks. Let's talk about stocks. Traditionally, that's more for like buy and hold, the traditional way, right? You put your money in the stock market, you look for the average 4 to 5% return a year over time. You have times where the market has a 50% cut, but still long-term investing over time still averages like 4 or 5% growth, sometimes 6% growth, right? If you're strategic enough, you kind of know when to go cash after the dip, get back in, you make a little bit more. You try to get like your 10, 15% return a year. But usually when we trade stocks, you're not looking to double up, triple up, quadruple up within inside of a single year, right? You're just really you're trying to make 10, 15% a year on your money. Why? Because that's what like mutual funds can do for you. Money managers can do that for you anyway. So the reason why you do it yourself is so you can cut out the fees. And plus you kind of own an asset. You can also trade ETFs, which are designed to be a little bit less expensive. Introduce yourself into the stock market, right? But the ETF is kind of pegged to the underlying asset, so therefore, even though there's not a whole lot of liquidity, it's still going to hold true to the price point because the market maker is going to peg it. So you can still trade ETFs. If you don't know what ETF is, electronic traded fund, basically it mirrors the underlying asset, makes it less expensive, so you can actually trade it, but it's not really a true asset. You don't really own anything. It's just, right? It's almost like a savings account or a bank account that you're buying shares and selling shares into. The asset itself, that's like something tangible that you can actually hold on to, okay? Now, anyways, so again, futures is more for like day trading, end of day, out today, trying to get paid today. Stock market, a little bit more of a longer term investment, but it does require a little bit more of an investment for stock traders. Unless you trade like penny stocks, but if you trade penny stocks, you have that day trading rule. You got to have like $25,000 in your account inside the United States to even day trade. That means enter in today, exit today. That's why a lot of people will trade futures instead of stocks if they don't have a whole lot of money, because it gives them the opportunity to make some money over time. Same thing with stock market, make money over time. Now, what about the options? So options is kind of like a mixture to where if you don't have a lot of money and you want to take advantage of the gains or the movements of the stock, you go trade options. It's a nice way to have the right, not the obligation, to trade the asset or the underlying asset or the ETF or the stock, but you trade the option. Now, there's a little bit more to learn. Now you're dealing with expirations. Now you're dealing with applied volatility. Now you're dealing with the Greeks. A little bit more sophistication. Not impossible, but a little bit more sophistication. Some people, what they do is they learn a strategy that works on an ETF or a stock. Instead of trading the ETF or the stock, they just trade the option because it's less expensive. But they still get, about 50% of the actual reward, through the delta, 50, 60% of the, on the dollar of movement with the option versus trading the stock outright with less money. So what's the difference between all of them? How should you start out with? Most people, brand new, what I've learned is they'll trade and they'll learn. They don't have a lot of money. They'll learn futures first. Then they integrate and they learn a strategy on stocks, they learn a strategy on ETFs, but then they realize they're gonna have $25,000 in their account. And if they don't have that, then they turn around and they say, well, I'm gonna learn the option, because you can try to take advantage of the stock or ETF movement with less risk. But it does require a learning curve. You gotta learn implied volatility, you gotta learn your Greeks, you gotta kind of understand the bid and the ask, how to work the orders. So this way, not use market orders, use limit orders type of scenarios. But ultimately, it's gonna be your decision. Hey everyone, this is Joshua Martinez. Hey guys, if you enjoyed this video and you want to stay up to date to my weekly content, go ahead and subscribe to this channel, tradersagency.com. If you want to be notified every time I post a video, go ahead and click on that bell down below. If you want even more information, don't forget to visit my website at tradersagency.com and subscribe to my free weekly newsletter where I send out my research on market opportunities. Thank you for the opportunity. Have a wonderful day.